Saturday, June 20th, 2020, Maneco 64, home of alternative economics and contrarian views. Today I'm going to talk about the fact that there's a universal flight from fiat currencies into real money, gold and silver, of course. I'm going to focus on gold. I've been at this for over 10 years. Before I even started my YouTube channel, while I was still working in the city of London, I used to keep a private blog called forsoundmoney.com, and I wrote about how all fiat currencies were sinking even back in 2007. So here's the article that I wrote back then. I'm going to put a link to it below in the description. It was published on this website, as you can see, marketoracle.co.uk. But about 6 weeks ago, I touched upon this flight from fiat currency. And I just wanted to update the viewers, not only in the US or the UK, but all around the world, as to what their national fiat currencies are doing versus gold. So I've decided today to do an update 6 weeks later about how all the national currencies are doing versus gold. And I would say that there's a term in the markets, in the bull market, it's called climbing a wall of worry. And I've noticed, of course, the last few months, especially the last month, where gold has gone nowhere. Gold has been many times hit hard below 1700. There's a big worry, and I think that's what it is. It's a bull market. There is a wall of worry. The other thing that, in my opinion, is very positive, as we know, since 2001, gold has performed very well against all the major currencies. The average increase has been just over 10% versus all major currencies, and that's not since 2001, that's annualized. So gold has been the place to be. And why is that? Well, because the central bankers have gone mad. We're gonna probably have zero or negative interest rates around the world for almost 20 years. I don't think they're gonna be able to raise rates anytime soon. And they got down to zero, of course, back in 08-09 after the crisis. Yes, the Federal Reserve under Jay Powell tried to raise them back up, but it was going to be a disaster, so they cut them back very quickly. And before I look at the charts and compare the charts from the closing of yesterday to April, I just want to show you a couple of stories that have come out in the last 24 hours or 36 hours. The first one is very important. I think it's about China. Both of these stories are on Reuters. In China, of course, is the second biggest creditor of the United States, of Uncle Sam. Japan, of course, holds the most treasuries, but this is important. It says China won't adopt flood-like stimulus nor negative rates, regulator. And a lot of you are going to make comments about China, how it's a dictatorship, that it's got a lot of debt, and it does, but it doesn't have the reserve currency. And I'm just looking at the facts. I'm looking at the money. I don't care about the politics right now. It says China's top banking regulator said on Thursday that the country will not adopt flood-like stimulus nor negative rates, warning that unprecedented easing by the Federal Reserve will dent U.S. credibility. Wu Shuxing, chairman of the China Banking and Insurance Regulatory Commission, or CBIRC, also urged major global economies to consider how to exit from massive easing. So he's not just warning the United States, he's warning countries like, well, the Eurozone, not a country, but a political union, the Euro area. I guess he's warning the UK, of course. We just announced through the Bank of England another 100 billion in QE. So this is what he says: major economies should actively consider the external impact of their own policies in a highly integrated global economy. Policies adopted by developed countries have a big impact on developing countries or nations, Guo said, urging governments to think thrice before rolling out fresh stimulus measures. There's no free meal in this world, and you must pay a price for your blank checks, Guo said, citing lessons from the previous crisis. I agree with him 100%. Yeah, I know China is a communist country and they have the Communist Party, but what he said is true. There's no such thing as a free lunch or a free meal, as he said. And that this is something I've been saying for years, and especially in the last few months, because there is a consequence to all this monetary and fiscal stimulus. So let's continue. He says, when you introduce large-scale stimulus, everyone is cheering. It may be very painful at the time of exit. Well, we know how it is. We know how the Fed tried to do that and how the stock market was collapsing in late 2018, and they had to reverse their policies last year. They went from being expected to continue to raise rates to cutting rates and starting not QE again, as we know. China has guided lending rates lower, cut bank reserve requirements, and pumped out trillions of yuan in liquidity, but is cautious about opening the floodgates further as its economy gradually recovers from the health crisis. The Institute of International Finance estimated that China's total debt hit 317% of GDP in the first quarter of 2020, up from 300% at the end of 2019, the largest quarterly increase on record. So China as well hasn't really been too frugal. Guo said a dollar-denominated global monetary system had played a role in stabilizing the global economy, but massive domestic stimulus in the US risks denting sovereign debt and dollar credibility. I totally agree with him. So he's not slagging off the dollar. He's actually saying that it's helped stabilize the global economy, but he says that there is a limit of how much stimulus a currency that needs to be used as the global reserve currency and that needs to have credibility. There's a limit to how much this stimulus can continue. And this is the interesting part here that I've been talking about. And of course, the mainstream economists, politicians, central bankers, they don't see this, of course. They think we have deflation. So the article ends by saying the regulator said that it takes time for the global supply chain to recover, predicting that high inflation could return. So there you go. The other story came out yesterday, and I've got it from Reuters as well. It says, U.S. economy will likely need more support, Fed's Rosengren says. So, of course, he's not going to listen to a Chinese official. The Fed is basically playing up this crisis as well. It's saying that they're going to need more stimulus, but not only monetary stimulus. He also talks about how the economy needs more fiscal stimulus. So the Fed is even involved in trying to set fiscal policy, which is not their remit. That's for Congress. I won't go through this whole article. I'll put it down in the description, the link. You can go through it. But it just goes to show that the Fed is nowhere near ending its stimulus. And I know, though, that the latest data for the Fed's balance sheet came out Thursday night, London time. We saw actually in the latest week, the Fed's balance sheet actually went down quite a bit. And it's no coincidence that the stock market has stopped because the balance sheet has stopped growing. Is the Fed going to pull the plug on the markets? I don't know. Or is the Fed waiting for another move lower so it can be justified in doing even more QE and then increasing the balance sheet again? I don't know. We have to keep an eye on the balance sheet going forward. It's very difficult to say the intentions of the Federal Reserve. On the surface, we might think that they don't want to let the stock market collapse and everything come down, that they will continue to stimulate the balance sheet, like Rosengren has been saying, like Kashkari has been saying. They've got limitless amount of money or fiat currency they can create out of thin air, and so has Powell said. So it will be very interesting to see what happens in the next week or so, especially to the markets and the balance sheet of the Federal Reserve. So there you go. That's the situation. So let's look at the fiat currencies. The universal flight continues from it. And I've always said before that the only store of value or measure of value, yardstick of value, that all national fiat currencies, the dollar included, can devalue against is gold, because gold has been money. As JP Morgan said, gold is money, everything else is credit, and it's been for thousands of years. Currencies can't devalue against each other if there's to be a reset or a revaluation of these currencies. And why is that? Well, because let's say the dollar starts devaluing a lot against the euro or the Swiss franc, those countries in the Eurozone and in Switzerland, their central banks will start devaluing to try to catch up. So it's a zero-sum game. They keep, in the end of the day, the only currency that is neutral, the only money that is neutral is gold. So that's why you need to look against gold. And here's the political map of the world, because they're national political currencies. So let's have a look at the United States dollar. And the chart on the left is from April 4th, when I did my last update on these fiat currencies and how they're all sinking. The other thing as well, they all sink at different rates in different times. The last time I did this update, you will see there was the Aussie dollar that was sinking very quickly, and the Aussie dollar has gone up to the surface or towards the surface a little bit, but it's still sinking in the long-term scheme of things. So here's the dollar, left-hand chart, April 4th, so about 6 weeks ago. So you can see, yes, it's climbing a wall of worry. So we're near the high of the year now, above 1700. At the time, we were below 1700. And you will see that the US dollar is the only fiat currency that hasn't made an all-time high this year. But I think we're close to doing it. And it might take a little longer, but I think once we break through 1800, we could very quickly be near the highs of 2011, just above 1900. So there's the British pound, climbing another wall of worry here. Recently, we've seen the pound strengthen a lot. So we saw the price of gold drop sharply versus the British pound. But as you can see, we're back above 1400 and we were below 1400 back in April. So we're continuing to climb this wall of worry. A bull market is called a bull market because it's hard to stay on that bull market because it's very choppy. And that's why for traders might be good, but for us who use precious metals as a savings instrument, we just need to sit tight and keep stacking, I would say. Here's the euro, same kind of scenario, and we're even higher. So the euro is continuing to sink. It's gold that's going up. It's the euro that's going down. So we're almost back to around 1600. We've had a spike lower as well, like in the British pound, but now it's coming back up. And if you look, previously we had another spike lower, and then we went up and higher highs and higher lows. So that looks very good longer term. And these are all weekly charts, of course. Here's the Chinese yuan. We're at all-time highs. Back in April, when I updated all these fiat currencies, we hadn't reached an all-time high. Swedish krona. So we see the Swedish krona is pretty much where it was in April. So the Swedish krona has taken a breather, I guess, sinking further, or gold has taken a breather. But you can see the longer-term trend is lower for the krona, higher for gold. New Zealand dollar, we're pretty much where we were back in April, but I would say like the Aussie dollar, if you look at how much higher it is than the all-time high back in 2011, it's normal that it's taking a breather, but you can bet it's not stopped going lower either. The only way the New Zealand dollar, for example, or any of these national currencies could stop going down versus gold is if we saw their central banks adopt a completely different policy from the major central banks. And you can bet they are not going to do that. They're all on the same hymn sheet. So here's the Aussie dollar. Should my Aussie viewers be concerned? I don't think so, because the Aussie dollar was sinking very quickly back in April. So it's come back up a bit, or gold's come back down, but the trend's still the same. Swiss franc. Well, there's another currency that's made a new all-time low versus gold, or gold has made a new all-time high. So the Swiss franc has sunk quicker than the Aussie dollar, for example. But we've made a new all-time high, and we're right near that level right now. And we're seeing the same kind of climbing a wall of worry move as the other major currencies. The Brazilian real, well, that's even worse. That hasn't even taken much of a breather to stop sinking, and gold is continuing to spike higher, as you can see. It has come off the highs, but still way above where we were back in April. There's the Danish krona. Well, the Danish krona has continued to sink. We're now at 11,632. We were at 11,200 back in April. Japanese yen. Well, a lot of people talk about how Japan has been in a deflation, that the Japanese yen is a safe haven, but we're right near 200,000 or 190,000, I would say, but we're way above where we were back in April. So the Japanese yen, is it really a safe haven? No, it's not doing well either. That's why it's good to look at these things, at the bigger picture. You can't just look at things on a short-term day-to-day basis. Canadian dollar, same story. Yeah, we've seen a big spike lower, but now we're rebounding and we are even back above where we were back in April. Indian rupee, well, the Indian rupee, as you can see, there's been some big spikes up and down, but it's continuing to sink versus gold. And we're about 10,000 rupees higher, the ounce of gold. And here's the Norwegian krona as well. We saw a big move higher in gold earlier in the year. We have corrected quite a bit. And why is that, the Norwegian krona? Well, it's partly to do with the oil price. Norway is a big oil producer, but you can see that even the krona is starting to sink again. We're a little lower than we were in April, but as I said, these currencies, they all take turns. So this is a lot like the Dow theory. The Dow theory says that all the different sectors of the economy, or the different indices like the transports or the industrials, they need to be going up altogether, making new highs to confirm the bull market. And I would say that this is the gold theory, that in a gold bull market where gold is more than just a normal commodity, but is actually a monetary commodity or money, you need to see all the national currencies making new lows versus gold, or gold making new highs, and that has been the case, except of course for the US dollar, and that's why we need to keep an eye very close to the dollar price of gold. Once we make an all-time high in gold versus the dollar, I think the gold bull market will be even more how can I say, it's going to be even more of a bull market. It's going to be even harder to stay on that bull. But if you know what's happening in the monetary world, in monetary policy, it will help you stay on that bull, even though it can get quite scary and wild, that ride. But it will reward people in the long term, those who stay on that precious metals bull. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.